bit of housekeeping. The first thing is that everybody is listen-only mode. So if you have questions, please use the question toolbox and we'll address those questions at the end of the webinar. We are recording today's webinar and it will be put on our website afta.com.au from later today so that you can revisit and watch it or share it with colleagues. And finally, before I hand over, I just want to say that tickets for the National Travel Industry Awards Gala Dinner is almost sold out. The event is on Saturday, the 21st of July, and we have a fantastic lineup of entertainment and prizes, and I think the best ever that we've ever had. So if you're thinking of coming, don't delay. Better put in a ticket request, and those ticket requests are available on the AFTA website. Okay, guys, I'm going to hand over to you and take it away.
Thanks very much, really appreciate it, and thank you everybody for joining us today. As I said, as Steve and I are going to run through a few issues with you. Just as a bit of an introduction, I just want to introduce DFK Australia New Zealand for you guys who haven't heard about us before. DFK Australia New Zealand has 15 independent firms around Australia and New Zealand that provide tailored and a complete range of accounting services, tax, audit, business advisory services for small to medium-sized businesses around Australia. We also liaise with our DFK international colleagues to help clients with businesses or investments overseas. So we've got firms in just about every capital city. So if there's ever a time that you need a second opinion or fresh insight onto how your business is operating, just give us a call. I'll now hand over to Steve to introduce the webinar topics to you. Thanks, Steve.
Thank you, Melissa. Thank you. I'll start with that famous statement by the late Kerry Packer, which is up on the screen, where he stated, "I don't know anybody that doesn't minimise their tax. I'm not evading tax in any way, shape or form. Of course I'm minimising my tax. If anybody in this country doesn't minimise their tax, they want their head read." Well, perhaps we're not going to be able to provide you with the level of advantages Kerry had, but we will try and at least give you something suitable for your businesses. Okay. Our goal today is to provide you with fresh insights into the latest tax changes and things to do before 30 June to take full advantage of concessions available to you and your business. And what we're covering, the first, which is part A, which is going to be done by Melissa, is the federal budget implications for individuals, business and superannuation. And then the second part, where I will come back in, is year-end tax planning, and that is benefits of tax planning, income strategies, maximising expenses, superannuation and capital gains tax. At the end of this webinar, where there are two resources which you should be able to see on the right-hand side of your screen, which are some tax planning insights for both businesses and individuals. So if you want to download those, you're more than welcome. I now hand over to Melissa, who will start with the federal budget update.
Thanks, Steve. So the federal budget this year was actually relatively boring compared to previous financial years. But I'm going to break it up for you between individuals, businesses and superannuation. From the individual's point of view, the main thing that the government sort of announced was that we were going to do step one of a 7-year plan for changing the personal tax rates. So step one for this 2019 financial year about to start is that they're going to increase the tax bracket threshold from $87,000 to $90,000 that you pay 32.5% tax on. For those of you who haven't seen the marginal tax rates put this way before, the idea is that your first $18,000 worth of income, you don't pay any tax on it. Then between 18 and 37,000, you pay 19% on that amount of income, and 32.5% now on income between 37,000 and 90,000. Eventually, as they progress through their 7-year plan, they'll actually get rid of this 37% tax bracket. What they did change in the personal area for individuals was the Medicare levy. Originally last year they had proposed to increase this Medicare levy a little bit, but they've decided to leave it the same, so that's good news. The other thing that they introduced was this new low income, middle income tax offset. The way that's going to work is we've still got the low income tax offset, which means that when you lodge your tax return, if your income's below 37,000 and you get a credit of $445, that credit is taken into account in the amount of tax that your boss takes out of your pay each week. So it's already built into the tax tables, if you like, as for how much tax the boss takes out of you. What they've introduced, this new low income and middle income tax offset, it's not, you won't get it via lower tax taken out of your pay each payday. What you'll actually get is a credit when you lodge your tax return at the end of the year. So when you lodge your 2019 tax return, you'll get a credit for this new tax offset. For people earning up to $37,000, they'll get a maximum tax credit of $200. If you earn between $37,000 and $48,000, that $200 will progressively increase up to $530. Once you hit $90,000, that's it. It's $530, and once you're you get a flat $530. If your income's between 90 and 125 grand, it'll progressively reduce down to nil. So there's a lot of people out there who'll get at least something out of this personal tax offset. This federal budget confirmed that what they'd announced in the last one is still applying, and that's to do with rental properties. So the rules had changed. I'm not sure how many of you have got investment properties, but the idea is that in this year's 2018 tax returns that you're about to do, if you've got a rental property, please note that travel to and from your property to inspect it, for example, or to do repairs and maintenance, that's no longer going to be tax deductible. And they've also changed the rules to do with depreciation on rental property items. So if you replace, for example, a hot water service or an air conditioner or some carpets, that kind of thing, when you buy them new, you'll be able to claim depreciation on those items, which just means you get the tax deduction over a number of years. But what this has changed is that if you, for example, buy a second-hand item, or more to the point, if you buy a brand new rental property that already has these items in it, you won't be allowed depreciation on those anymore. What used to happen in the past was you'd get a quantity surveyor report who'd go and value your hot water service, your carpets, curtains, light fittings and bits and pieces, and then you'd be able to claim depreciation on those items even though they were bought as part of the purchase price of the property. So those rules aren't changing. From a business's point of view, what they're doing is continuing to extend the applicability of the 27.5% tax rate. It used to be to businesses with only a turnover of under $2 million, then they extended it to a turnover of $10 million. Now it's if any small business, well, a small business, or now what's called a base rate entity, if their turnover in the 2018 financial year is under $25 million and they're carrying on a business, then they're eligible for the 27.5% tax rate. And starting next financial year, if a business's turnover is less than $50 million, then they'll be allowed to use the 27.5% tax rate. If your turnover is over those thresholds in the relevant financial years, or if your business is not carrying on a business, or the majority of its income is not coming from carrying on a business, then the old 30% tax rate still applies. So for some of you who might, say, have an investment company off to the side, that'll still be subject to the 30% tax rate. What it does mean is that you do have to be a little bit careful and talk to your accountant. For those of you who have retained profits and take dividends out of your companies, trading companies, you do have to be careful. Your company will have paid 30% tax in the old days, but any dividends coming out now will only get a 27.5% franking credit attached to that dividend. So you just need to talk to your accountant to make sure that you are getting as much benefit as you can out of those franking credits, given that the tax rates are dropping. The good news is that the government in the federal budget announced that they were going to extend the instant asset write-off. So that's the 100% depreciation that you're allowed to claim on items costing less than $20,000 each, net of GST if you're GST registered. So the idea here is that this has been in place or been extended 2 or 3 times now. Before that, anything costing more than $1,000 you used to have to put on a depreciation schedule and claim over time. Then the government introduced this $20,000 rule, so most people have been able to write off just about all of the equipment that they've been buying. So particularly when you're talking computers and some types of office furniture that cost more than $1,000, this is a great advantage that you get to claim your 100% depreciation on anything up to $20,000 now. I'll jump to the bottom one first. If you do buy anything more than $20,000, then the normal rules still apply. You can allocate that to an SBE pool if your turnover's under $10 million. What that simply means is that you get 15% depreciation on that item in the first year as a flat rate, regardless of when you bought it during the year, and then you get 30% per year as depreciation thereafter of whatever's left over, so it progressively tails off. An interesting feature of this system is that if you've got a general pool, for example, with leftover assets from previous years before this 20,000 came in, or even, for example, you've bought a car or company car or something like that that's gone into the SBE pool, when that pool balance gets below $20,000, then you're at the beginning of the financial year, then you're actually allowed to write off the balance of that pool as a complete tax deduction for whatever's left. So that can be quite a handy tax deduction too. So again, just have a chat to your accountant to double check where your plant and equipment's at and whether there is some extra tax deductions available to you there. So that's it on the concessions, the nice things that the government has introduced. What we really need to highlight to you this year is that they've also introduced some nasty new tax traps for business owners that start from the 1st of July 2019. So the ATO and the government's really doing a crackdown on compliance issues. And what this means is that, for example, they're trying to introduce a new rule here where if you pay wages to your employees and you deduct the PAYG, normally, and hopefully all of you guys will be putting that on your BASs and paying that PAYG to the tax office on each either monthly or quarterly BAS. What the government's now saying is that if you fail to report that PAYG or wages on your BAS, or you don't get around, for example, for cash flow issues, to paying the ATO that PAYG, the ATO is reserving the right to make the whole payment for the whole gross wages, not even just the PAYG part, but they're going to make the whole lot non-tax deductible. So it is critical now that you guys manage your cash flow correctly so that you're able to pay your BASs on time, and it's critical that you have really good bookkeeping systems and particularly payroll systems to make sure that you are putting the right gross wages and PAYG figures on your BASs. Now, there is a lot of fine print still to be determined and legislated. So if there are simple accidents, the ATO's probably going to let it go through, but so what I'm trying to say is that they haven't defined the time frame within which it has to be reported or remitted. So, for example, if you make a genuine mistake and you fix it up on the next BAS, the ATO is not going to get upset. But if you're one of these companies who month after quarter is still not paying your taxes on time, eventually the ATO is going to get upset and say, look, that's it, we're denying your deduction for your gross wages altogether. So we're still waiting on that fine print of legislation to see exactly where they're going to draw the line, but that's what's been announced so far, and we're just waiting on the fine print. Along with that announcement was also one to do with payments to contractors. Now, you guys should know that when you're running a business, you either pay somebody who's an employee and they've given you their tax file number and you deduct PAYG out of their wages, or they're a contractor or supplier and they've given you a tax invoice with their ABN on it, whether they're GST registered or not. But the current rules, and these aren't changing, the current rules are that if you get an invoice from a contractor or supplier that doesn't have an ABN on it, then you are actually legally required to withhold 47% PAYG out of their invoice payment and only give them the net amount, and that tax you put on your next BAS and send it off to the government. Again, the ATO is tired of people not complying with this rule, and they're now saying, or have announced, that if they catch you making payments to people where you either don't have an invoice or don't have an invoice with an ABN on it, then they're going to have the right to turn around and say, we're not going to let you claim a tax deduction for that payment, and B, you're in trouble for not deducting the 47% tax. So again, please go back to the office and make sure that whoever's doing your books and paying your bills really drum into them that these new rules are coming, and they have to be and they will be backdated to 1st of July 19. So we do have a little bit of a transition period to wait for that legislation to come through, but they really do have to start being very careful to make sure you've got proper tax invoices and genuine ABNs on them to make sure that everybody's paying their fair share of tax. Two other nasty bits that they've announced too is that businesses are banned from receiving cash payments exceeding $10,000, obviously excluding banks because that's where you go to deposit your money. But it does mean that, particularly as travel agents, I don't know how often you guys have people wanting to pay for their holidays in cash, but the ATO, as part of their crackdown on the cash economy, is saying now that as a business owner, you will get in trouble if you receive a cash payment. If somebody comes in and books a holiday and pays for the whole thing in cash in one go, you guys are going to get in trouble. So please, again, let your teams know that from 1 July 2019, they've got to try and make sure that people pay, I guess, through FPOS or credit cards or whatever, and aren't dropping in cash over the counter in excess of $10,000. The other one, the last new tax trap to watch out for is that for businesses that do get in trouble and have cash flow wise and aren't able to pay their BASs, for example, to the ATO on time, there's already a system in place that says if you as a director of your company, you're at least lodging your BASs and telling the ATO that you owe them PAYG, if you can't, if the company can't pay that PAYG on time, and you haven't entered into a satisfactory payment arrangement with the ATO, then the ATO already has the right to issue a director penalty notice, which basically means they say, look, the company's not paying, we're tired of waiting, we're going to issue a notice to the director and say, look, you're in charge of this company, we want the PAYG and we want it now, and they can basically sue you personally for that money. Same applies for superannuation for your employees that hasn't been paid on time or at least as part of a payment plan. So again, what this means is that you have to be really careful with managing your cash flow to ensure that you can pay your bills on time, especially to the tax office for PAYG and SGC. And what they've announced now is that they're going to actually extend that, and it's not just the PAYG and SGC components. The government is now going to be able to effectively sue you personally, make you personally liable for the GST component of your BASs as well. So if your company, for whatever reason, can't pay its bills on time, particularly its tax office bills, then this means that you need to expect a director penalty notice, and they're going to come after you for it. Now, you guys are usually pretty lucky in that AFTA keeps a close eye on you, and you've got requirements to meet those. So I'd like to think that not too many of you are going to get in trouble on this front because you're managing your businesses so well. But those are certainly the tax traps that have been announced in this new federal budget. Moving on from those to superannuation. Superannuation is a very tax-effective way of saving up for your retirement. So I'm just going to confirm that the concessional, the tax deductible limits for the 2018 financial year is $25,000 per person regardless of age. So you might have employee salary sacrificing, for example, up to 25 grand a year, or even you guys might want to be doing a bit of year-end tax planning that Steve will be talking about in a second, and maybe look at topping up your contributions for the year to take advantage of that. And in the federal budget, they announced that there was no change to that threshold. What is different, announced last year, is that employees themselves can top up their superannuation themselves, i.e. pay it personally and claim a personal tax deduction in their own tax return. So, that obviously applies to you guys as well. As employees of your own business, you can either get your company to top up your superannuation, or you can do it yourself, or maybe for your spouse, you can let them know that, maybe there's an opportunity that they can make a contribution and top up their super if that's what's right for them. And what they did announce this year was that once you're over 65, there's a work test that applies to be able to keep making contributions into your super fund, and they've just extended or relaxed, I should say, that work test a little bit so that it doesn't apply from the minute you turn 65 or retire. It doesn't apply for the whole first year after you retire, so that you can retire, sort out your finances, and then if you discover you've still got some left over, then you can put some more into superannuation without having to worry about having to satisfy that work test. I also wanted to bring to your attention the superannuation contributions tax. So basically any concessional contributions that go into a super fund, for example, employer payments or any of these personal member contributions that go in, the super fund takes 15% off those contributions and gives that to the tax office straight away. But for individuals earning more than $250,000 per annum, after you lodge your tax return, the ATO matches up how much super has been put into your accounts during the year versus what your when they see what your tax return says your taxable income is. If it's more than $250,000, then they send you a bill for an extra 15% tax on those concessional contributions, and you have the choice whether to pay that personally or whether you forward that bill to your super fund for them to pay. And what it's not exactly $250,000 of taxable income. It's what they call adjusted taxable income, which is your taxable income plus your reportable fringe benefits amount. So you can't salary sacrifice, for example, to bring your taxable income down to get under the threshold, and it also includes all the concessional contributions that you do make. So, for example, again, you can't salary sacrifice more into super to get you below the threshold so that your super contributions don't get taxed. But it also means they add back any investment or rental property losses. So again, you don't get to get your income down to below this threshold simply by buying a negatively geared rental property or something like that. The good news, though, is it doesn't include any superannuation lump sums that are eligible for the super tax offset. So that's probably not relevant to most people, but certainly when people start retiring and you get your lump sum payout upon retirement and you take a super lump sum, that's when that particular issue becomes relevant. But I mean, the good news is still that even if you are lucky enough to be somebody earning more than $250,000 odd, even though your super contributions are getting taxed at 30%, that's still better than paying 47%. So, you know, don't stop just because the tax office is going to charge you a little bit of extra tax. And in the federal budget, the government announced that there wasn't going to be any change to that rule. Last but not least, if you've maxed out your personal or employer concessional contributions, another option for getting money into superannuation is to make a non-concessional contribution. That's after tax deduction. So you get paid, you pay your tax, the boss gives you the net pay. If you manage to save up some of that, or perhaps you've got money from somewhere else, One Tax Lotto or whatever, if you've got some cash lying around, you can make after-tax contributions to your super fund. In the 2000 financial year that's about to finish, there is a cap of $100,000 per annum, or you can actually make a contribution of $300,000 in one go using those 3-year bring forward rules. All that means is that you then can't do anything for the next 2 years. And they designed that so, for example, if you sold a rental property or some investments or whatever and needed to put in more than 100 grand, then you sort of got around it that way. But you do have to watch out that if your super fund balance is already more than $1.6 million, then you aren't allowed to put in any more concessional contributions. And remembering back to the previous slide, there's that work test and things like that. So there are age limits on these contributions. So before you put any substantial amounts into your superannuation, if you are getting close to 65 and or have issues with how many hours a week you're working or your balance of your super fund's about the 1.6, either way, go and talk to a licensed accountant or financial planner to get confirmation on what your actual limits are before you go putting a whole chunk of money in. Again, no change to those thresholds for the 2019 year. It'll be another year or two before those get indexed any further. And one last thought, just be careful. These amounts have changed over the last few years. So if you have used this bring forward rule in the past, be very careful to make sure that any contributions you put in don't breach that 300K limit or whatever the transitional amount is in your particular circumstances. So again, whenever you're talking superannuation contributions, please do talk to your licensed accountant or financial planner to make sure that you're not going to breach any caps accidentally, because you know, the tax and interest on that, penalties on that's just not worth the effort. So on that basis, I'm done. That's the updates that you need to be aware of out of the latest federal budget. So I'm going to hand over to Steve now to talk to you about the tax planning and things you can do between now and 30th of June to save yourselves an extra few bucks. Thanks very much. There you go, Steve.
Thanks, Melissa. So what is tax planning and why is it beneficial? Important things to remember. Make sure you keep good records of income received and expenses incurred, so all amounts included in your return can be substantiated. Remember, substantiation is one of the main things in tax. And as Terry Packer said, as he did, allegedly, always play within the rules. The best tax planning is done before the year end starts, not just before the year ends. Now, obviously, we don't have much time left for this year, so some of this you might have to think going forward for next year. And in all cases, for best outcome, we recommend talking to a suitable qualified advisor. Now, it's just special consideration for some AFTA members. There are two, one that's mentioned here. Remember, IATA members have a requirement to deliver a pre-tax profit. Now, that's relevant if you aren't providing either an insurance bond or bank guarantee. So you just got to be careful whenever you're looking at your financials, that by tax planning you don't put yourself into a loss situation, which may call up the requirement with IATA to provide either of those. And I think you've also got to consider, I believe AFTA does look at your business to an extent whether they are profitable. So you don't want to start running everything at a loss. Okay, first of all, we'll start with income strategies. Okay, where legally possible, consider deferring your income to the next financial year. It may be possible, especially where you've got monies in your trust/travel account, but be warned, if you are in a growth phase, it may come back to bite you. So it may be still more beneficial to bring the income in this year than into next year. Delayed payment of what it does is delay payment of tax for another year. Again, where you've got to look at is taking advantage of the 27.5% if your turnover is less than 25 million, sorry. So if you're on the borderline, it may pay to defer some of your income to next year, where the threshold will be going up to 50 million. So that is an area, if you're in that bracket, if your business is that good, that you look at. Okay, those who are operating out of discretionary trust, you should, before 30th of June, prepare and sign a trust distribution resolution, and especially if you've got non-working or studying children over the age of 18, you should use that. Also, try and make sure your trust deeds are up to date. Now, you've got to be careful, and this is where you've got to seek advice from your accountant or lawyer, because if by changing a trust deed, if it's classified as reconstituting the trust, there can be other tax consequences. But you should always try and make sure that your trust deed is up to date. Now, some strategies to assist with cash flow. Okay, so first of all, if you're paying quarterly tax, you should be looking at where your profit is and estimates, because you might be able to vary your pay-as-you-go instalment amounts if the figures aren't there. Again, on a personal basis, if you're an employee and you have negative gearing, or it could be motor vehicles, etc., where you might be, your taxable income may be below the estimated from your salary and wages, you can apply to the Commissioner for a variation in the tax amount. And the other thing is to look at, in your, whatever your situation is, the question of whether you take some of the monies from your business as wages versus as a dividend distribution. Again, that is generally you would do that in consultation with your accountant. So you need to look at that. Maximising expenses. consider prepaying the following expenses before 30 June. Interest, subscriptions, insurance, rent, and other deductible expenses. You can claim, if you're a small business, up to 12 months can be prepaid. So you often hear about people prepaying a year's interest on a property and things like that, or some of the rent. But again, you've always got to look at where next year is going to go. So sometimes you've got to be able to work out which is more beneficial for you. And also with this prepayment, it may be advantageous if you've got increased sales in a particular year to bring those deductions forward and help reduce your tax. Now, Melissa spoke about the 20,000 instant asset write-off. As she mentioned, it has been extended to the 20th of June. There are certain assets that are not eligible, but most assets are, and that includes second-hand goods. Bad debts. Writing off a bad debts means you can reclaim the GST and any income tax paid on the sale. Now, where you've got to be careful is that note, if you're writing off a bad debt, you have to have declared that income in your return first. You can't just write off a debt without declaring the income. So if people are running on a cash basis and they don't get paid, they can't write off a bad debt if they haven't declared that income. And there are stringent guidelines for what you can write off, and that comes back. Now, just on a bit of a sidetrack, cloud accounting. Cloud accounting is becoming more and more the norm within most markets. So the question is, consider the switch now. Some of the advantages is, obviously, compared to a manual system, is reduced paperwork and record income and expenses electronically. And one of the important things is single touch payroll is compulsory from 1st of July 18. Now, if you have 20 or more employees, you will need to have, well, they don't all have to be cloud products, but you need to have an efficient computer program that will talk with the tax office. So there are only certain programs that have their wages connected to make sure that you will be complying from 1st of July. Now, there are some of the programs out there which aren't quite ready, and the tax office has given some concessions on that, but it's coming. And from 1st of July 2019, all businesses that have less than 20 employees will also need to have single touch payroll. Now that means if you're trading as a company and you're the only individual, but you're on the payroll, you are going to need to have single touch payroll. So that means you've got to update your old MYOB or QuickBooks programs that have old wages programs. You will need to be on the latest. One of the disadvantages at the moment is with cloud accounting, there aren't many packages out there that are specific for travel agents. I've been trying to find a few, and they're very few and far between. I've been trying to put a lot of pressure on the Xero people that they work on getting someone to work on it, but at this stage, it's not all there, especially again if you're running client accounts. And many software packages are great for automation than previously available. Just superannuation. Well, again, Melissa's covered some of this, but let's just go ahead. Number one, superannuation is deductible when paid. Now that means for your staff, if you want to claim your tax deduction by 30 June, say this year, you have to have it paid. And it's not just paid, it actually has to be received by the superannuation company, whether it's your own superannuation company or one of the large ones, well before 30 June. Now, a lot of the larger superannuation companies are already saying you should be paying it now because they have an incredible backlog and it has to be received and processed by them. Now, for employer considerations, make sure that you are paying for all your employees, you're paying the 9.5% superannuation guarantee rules. The cost of this with penalties and everything else becomes quite substantial. So just review your reportable employer contributions. And again, as Melissa mentioned, that there can be advantages for salary sacrifice concessional superannuation contributions where they're only paying 15% of it on it compared to that could be up to the 47, 48.5%. And again, we have the $25,000 limit. And as Melissa also mentioned, non-concessional contributions, these aren't tax deductible, but they may be advantageous to have the money in there. One of the other things is in the change of the budget, or previously, the government allowed previously if 10% or more of your salary of your income was from salary and wages where superannuation was deducted from, you could not make personal contributions to bring you up to that $25,000 limit. You now can. So let's say your employers put in $3,000 or $5,000 as superannuation, you can top that up personally and claim it against your income up to the maximum of the $25,000. Capital gains tax. Yes, they keep on threatening to, well, Labor is to remove this or reduce it, but timing of capital gains tax event, there may be advantages in deferring the sale from 1 year to the next, again, because of whatever your taxable income is. However, two things you've got to consider: the date, it's got to be held for a 12-month period, and the date that you exchange contracts, let's say it's for a property, is the date of the sale. So if you're around 30 June and you want the sale to go through, it may be advantageous to exchange a contract in July, which will bring it into the next financial year, because that's the financial year that is taken into account when the sale is made. And against that, if you've got, and this might be things like shares or anything, if you've got a large amount of shares with a capital gain and you've got a few of what they call dogs lying around which are really not performing, it may be advantageous to crystallise the capital losses on those shares to offset the capital gain. And one of the other options is if you haven't maxed out your superannuation and you have capital gains tax income, is to increase your superannuation, your concessional superannuation contributions to offset some of that capital gain. Okay, I will now hand back to Melissa, who will wrap up the webinar. Melissa?
Sorry, thanks very much, Steve. That's great. So there you go, guys. You're now up to date with all of federal budget update, and you've got some tips on what you can do in the next couple of weeks to just do that final fine-tuning to make sure that you're eligible to claim as much as you can legally before the 30th of June. As Steve said, the best tax planning is actually done before the start of the financial year, but it helps to do this fine-tuning at the end. So while you're at it, use the opportunity to look at how you've got everything structured for the coming financial year, 2018-19, and see if there's anything that you can tweak in there to make sure that you're eligible for as many tax deductions as possible. In terms of what else we can do to help you, certainly feel free to give your local DFK ANZ member firm a call if you would like a second opinion or some fresh eyes, fresh insight into how your business is going and what areas there might be where you can improve things. The way we can help with that is to do everything from strategic planning workshops where we sit down with the owners of the business and maybe some of the senior team members, or we can look at business structures and setups, maybe the way you were set up when you first started, you know, sole trader, partnership, company, trust, that kind of thing. There might have been particular advantages of doing it that way in the beginning, but now your business has grown and developed. Maybe you're interested in bringing more people in and you know, adding extra shareholders or directors or something. So maybe your business structure needs to change. If you need any help with that, give us a yell. If you're at the other end of the spectrum and perhaps you're looking at how you're going to move on from running your own business over the next few years, we can certainly help you with business valuations and succession planning advice. We do warn people it does take some companies 3 to 5 years to get themselves organised, structured, tidied up, good quality financial reports. You know, because when you do try and sell your business to someone else, they're looking for 3 years at least worth of solid financial statements. So talk about systemizing and that kind of stuff to make sure you get every dollar possible as part of your sale price. Obviously, we do all the normal accounting, tax, compliance assistance. So if you need help with normal accounts and tax returns, FBT, or even bookkeeping assistance with, you know, setting up Xero or MYOB data files, payroll, bookkeeping, all of that kind of stuff, we can handle that for you as well. And otherwise, even if you just want a regular coaching meeting, you know, somebody to sit down and talk to, you know, we don't talk business and money with friends and family, so who do you talk to? Make sure you've got a good quality business advisor that you can chat to regularly about how things are going and what challenges you're facing. And for the businesses that are a fraction bigger, you know, we also offer ourselves as external non-executive directors that can sit on board meetings just to provide that extra perspective or different perspective to make sure that the business is heading in the right direction. So there's lots of different ways we can help you if you need a hand. So on that note, I'd like to say thank you very much for watching and listening to our webinar. We really appreciate your time and effort and hope you've got something valuable out of it. If you've got any queries, please pop them in the chat box and we'll work our way through those. And otherwise, yeah, thanks very much.
Thank you so much, guys. I personally found that really informative, even for some of my own personal tax. I'm just going to look at some of the questions here. Okay, so we have a question from one of our very diligent listeners, Janine. She's always jumping on when we have a DFK webinar. So she has asked, can you only claim the super when paid, but for the $25,000 cap, does that refer to the actual month's super regardless if it gets paid the following month? Quite wordy. Does that make sense?
Yeah, it does make sense. Yes, you do have to be very careful. The super fund, if the super fund receives more than 25 grand in a financial year, that's the problem. Then they will notify the ATO that they've received more than 25 grand. And so accidents are known to happen where last financial year your June super was paid in July because it's allowed to be paid any time up to 28th of July. And then this year the boss decides to pay the June super in June. And all of a sudden we've got 13 months worth in the 12 months of the financial year. And in which case, yes, you've gone over the threshold and that's not good. So you do need to to check when your boss is paying the super, and are they going to pay the June super in June, or are they going to pay it in July? Better still, double check with your super fund how much have they already received, and then only top it up for the extra.
Okay. So on that, the cap dropped last year, so the June payment is going to be more. Does that count towards this year's $25,000 cap?
Yep, it's on a cash received by the super fund basis.
Okay. Great.
Yeah, so if your June 17 contribution went into the fund in July 17 and was based on 1/12 of 35 grand, for example, or 30 grand, then you've got to be careful.
Okay, great, thank you. I've had a comment here that was a great presentation, a lot to digest, and is it possible to get the slides? Of course it is. We're going to put a copy of the slides as well as the full presentation on our website, so that'll be available from tomorrow or even later today, so keep an eye out.
And don't forget the handouts that are on the...
Correct. So after this, you'll get an email with a range of survey questions that we'd just love you to complete. That helps give us some feedback. There'll be some handout questions, and the handout questions will also be online for you to download, so they'll be really helpful.
If I can also say, if anybody has any particular topics that they would like us to cover, we've got a whole range of stuff we could present webinars on. So if you have any preferences or burning issues that you'd like us to address, just let us know, and we might be able to customise a future webinar for you that way.
Fantastic. I have a question here about employers working overseas. They might need to elaborate, but they're wondering how does it work for them? Is that might be with regards to super, perhaps that question might need to be fleshed out a little bit.
I think that would need, I think they'd be better off sending an email to one of us to answer that, because you need a few more facts than just be able to answer what they're actually looking at. And even there, it depends on if they're full-time overseas or doing a job overseas, short-term.
Right. And I guess what country and things. Okay,
Exactly.
I've written down that name, so we might follow that one up offline.
Okay.
I'm getting lots of thank yous and great presentation. Does anyone have any questions before we wrap up? Any final questions? If not, you can always contact us and we'll hand you over to DFK. If you do,
they can Google us.
Yeah, so they can Google. But the contact details will be on our website. Yeah, and they'll be on our website. I do have a question, and I think this goes back to the super we were talking about before. If you do overpay, what do you do about it?
You don't have to do much because the ATO will be in touch with you. So they will send you an excess contributions tax notice, and it will tell you how much you've over contributed by and whether you want to take that money out or leave it in there, but and how much penalty or interest you've got to pay, extra tax on it. They basically say that if you,
I think what they're saying now, if it's a small amount, you can take it back, but then you've got to add it against your personal income and pay, if you're in the top rate of tax, the 47.5%.
Okay.
Yeah. So they'll send you a bill, and then just follow the instructions on that. Yeah.
Helpful. All right. Well, that was the last of our questions. So, oh wait, I've just got one more. Maybe we'll do this one. What is the benefit of making non-concessional super contributions? Thanks, Mandy.
Can I do that one, Steve?
Yeah. Yep.
Sorry. The point is that if you invest money in your own name, so say you've got 10 grand left over at the end of the financial year, if you invest that in your own name, you're going to earn interest or dividends or whatever it is on that money that you've invested. The interest dividends goes into your personal tax return and gets taxed at your personal marginal tax rate. For most of you guys, it'll be somewhere between, say, 34% and 47%. Whereas if you put that money into the super fund doesn't have to pay the 15% tax on it. The whole 10 grand in this case gets invested. The investment earnings that the super fund earns on it, potentially investing in exactly the same thing you were going to invest in outside of super, that profit investment earnings will only be taxed at 15%, which leaves more money in the super fund working for you. And then that compounds over the years so that you get a much better lump sum at the end of it, if that makes sense.
Can I add there? I think you've got to look at your age too. Obviously, if you're in your early 30s and you're wanting that money in the next few years, you wouldn't do it. But if you're getting closer to retirement age and you can get at that money within a short term, that can also be beneficial. So you've got to remember, if it goes into the super, it's tied up in there till you reach retirement age.
Yeah, roughly age 60. So yeah.
Yeah.
And Mandy says thank you. All right, guys, for the third time, we're going to wrap it up there. Any questions? You know, the DFK guys are on hand, so we'll put their details on the website and you can reach out to them directly, or feel free to contact someone at AFTA and we'll hand you over. The slides, the handout sheets and the webinar recording will all be available online at the afta.com.au website. So thank you again for your time. Thanks so much, guys.
Thank you.
Thank you.